All right, let's jump right into Bank OZK's fourth quarter earnings. This report dropped pre-market on January 21st, and boy, it really gave investors a lot to chew on right out of the gate.
So, here's how we're going to break this all down. We'll start with the headline numbers, which were kind of all over the place. Then we'll dig into the real meat of the report, the credit story. After that, we'll look at management's big picture strategy, see how the market reacted, and wrap it all up with our own take on what to expect from the next call. Okay, first up, let's talk about those headline numbers. This quarter was a classic case of a split decision, what you might call a tale of two tapes. So on one side of the coin, you've got earnings per share coming in at $1.53. Now, that was a slight miss, but just barely, only by about 2 cents. But then you flip the coin over and you see revenue hitting over $440 million, which was a pretty solid beat of around $8 million. So you've got this weird mix, right? A revenue beat, but an earnings miss. So what did the market make of that?
Well, here's your answer. The stock immediately dropped 3.6% in pre-market trading. Now, a revenue beat is usually good news, so what gives? It turns out the real story, the thing that actually drove this quarter's reaction, wasn't on the top line at all. It was buried much deeper in the bank's credit metrics.
And that's the perfect lead-in to our next section, the credit story. If you think about a bank's core earnings as its engine, then this quarter's credit results were like a big mess, splattered all over the windshield, completely blocking the view. The problem just jumps right off the page when you look at these year-over-year changes. The money they set aside for credit losses, up 36%. Their net charge-off ratio, it absolutely exploded, going from just 0.16% to over 1%. And their non-performing loan ratio more than doubled. This is what sent a chill down investors' spines and completely overshadowed that strong revenue number. So, with a pretty tough credit picture, what's management's plan? Well, that takes us to their long game. They're trying to fundamentally de-risk the company's story by changing what the bank is and reducing its reliance on just earning interest from loans.
It's really a three-part plan. First, they're building out their corporate and institutional banking to offer more services that generate fees, things like loan syndications and hedging. Second, they're ramping up their mortgage business, specifically by making loans to sell them off for a fee, and also expanding wealth management. And third, they're piloting a new private banking service and investing big in treasury tech to land larger clients. The goal here is pretty clear: create a much bigger, more stable income stream that comes from fees.
But, and this is a big but, management is being very upfront about the timing. The CEO, George Gleason, was crystal clear on the call. He basically said, look, we think 2026 is another year where we're just working through the environment. He flat out told everyone that the real impact of these big changes won't really be felt until 2027 and beyond. So yeah, this isn't a quick fix, it's a long-term pivot.
Okay, so let's put this all together and get to the market's take. Honestly, the best way to frame this whole quarter is with that metaphor we talked about: a good engine, but a very, very messy windshield. And what does that mean exactly? Well, the good engine is the bank's strong core performance. I mean, their net interest income was actually up over 7% year over year. That's the part that's humming along nicely. But the messy windshield, that's all of that near-term credit trouble we just looked at. And right now, investors just can't see past that mess to appreciate the strong engine. They are focused squarely on the risk. So this brings us to our final section, the outlook and our rating for the next call. Based on everything we've just gone over, what should we be expecting moving forward? Here's our take. For next quarter's results, we expect the theme to continue. Solid net interest income, but the credit metrics are going to stay front and center. And as per their guidance, loan growth will likely be pretty muted. For the stock's price action, it's going to be a battleground. It'll probably trade quarter to quarter based on any tiny movement in those credit numbers. So, because of all that, we're assigning a market perform rating. The strong core engine is there, but it's completely offset by this 2026 credit cleanup. The long-term fee story is promising for sure, but right now, it's just a story. The market is going to wait for proof.
And as always, just a reminder, this is not financial advice.